Hi all, and thanks for joining us today for another Meyer Capital Group webinar. We thought the timing was perfect to talk about the post-election and what it means as far as tax policy, investment policy, Social Security, medical care reform, gridlock, so forth and so on, with the new 118th Congress, which will start in January 2023 to January 2025. And who better to discuss these important issues than with Michael Townsend. Michael is a Charles Schwab, Washington-based political analyst with more than 28 years of Washington experience. He analyzes legislative, regulatory, and political developments to determine how they would affect individual investors, retirement plan participants, investment advisors, and then develops these strategies to communicate to policymakers. He's the host of Schwab's popular Washington Lines podcast, which explores the intersection between policy, politics, the markets, and the economy. Prior to joining Schwab in 2000, Mike served as an aide to 2 U.S. senators and worked at Powell Tate, a Washington, D.C. public affairs firm. He's a graduate of Bowdoin College in Maine and holds a master's degree in English from George Mason University. Michael, thanks so much for joining us. I know your plate is full, but please help us understand what the heck is going on in D.C.
I will do my best. Hi, everybody. Great to be with you from sunny Washington. Very interesting times. We've got Congress still in town trying to get across the finish line. The new Congress getting ready to come in just a couple of weeks. So lots to talk about today. But, as was said, my name is Mike Townsend, and I'm part of a little team at Schwab. There are 5 of us here in DC. It's our job to watch what's going on Capitol Hill, halls of Congress, the White House, all the regulatory agencies, the SEC and the Fed and others, and really try to figure out what it all means for individual investors. I spend a lot of my time doing this, talking to investors about what's happening in Washington. I sort of think of my job as helping you all cut through all the noise and the nonsense that goes on in DC and figure out what's really worth paying attention to. So I will tell you right off the bat that most of it is noise and nonsense. So we're going to try to hone in on exactly what is worth it for investors. And so I'm going to take just a second here and share my screen so you can see my little slides, and then we'll jump right into it. So I'll start by talking a little midterms. The thing about this midterms, and it seems like all of the elections these days, is that when you're listening to the pundits and the predictions and all the analysis, nobody knows anything. And one of the things that we found this year was that polls were not great, but they weren't as terrible actually as they've been in the last couple of elections. I think one of the things that happens in midterm elections is that the media gets so focused on the horse race, sort of, head-to-head matchups. And so they feverishly report that so-and-so is 2 points ahead, but they don't sort of provide the context that maybe the margin of error in that poll is 4 or 5 points. So the fact that the other candidate won by 2 points is not this shocking upset, but really all was part of the margin of error. So I think that's something that gets lost in a lot of these elections. But as I think everyone knows, the Democrats did increase their Senate majority to 51 to 49. And that is the result of after last week's Georgia Senate runoff, where Senator Raphael Warnock, the Democrat, managed to hold off former football star Herschel Walker, the Republican nominee, to get reelected to the Senate. That created a 51-49 majority. And that's going to stay that way, even though you may have heard Kyrsten Sinema, the senator from Arizona, Democrat, announced on Friday that she was leaving the Democratic Party and would become an independent. She joins the 2 other independents who also sort of are affiliated with the Democrats in the Senate. Senator Angus King from Maine, Senator Bernie Sanders from Vermont, now Senator Sinema from Arizona. But all 3 of them continue to sort of, be tied or connected at least to the Democratic Party. And so they'll vote from, structural and procedural things to keep that 51-49 majority. One other thing to say about that, the 51 votes matters in the Senate. Of course, it's been a 50-50 tie over the last a couple of years, with Vice President Harris holding the tie-breaking vote, and it was that tie-breaking vote that then gave the Democrats the marginal majority. But when it's 51-49, you don't need the Vice President to break a tie vote necessarily, because if all the 51 hold together, then you don't need that. And second, it means that the Democrats will have a 1-seat advantage on all of the committees. And the reason that matters is that when you have tie votes in the committees, which has happened lots and lots of times over the last couple of years, and when the committees are equally divided between Republicans and Democrats, that just adds a whole nother procedural step, takes another multiple set of steps and votes to get something to the Senate floor. So things will be streamlined starting in January a little bit for Democrats. Of course, 51 is hardly an overwhelming majority, so nothing is a slam dunk. One of the biggest impacts is that the Democrats will be able to continue to confirm judges to federal judiciary positions. I think that'll be a big thing that they'll continue to focus on over the next couple of years. Over in the House side, Republicans did capture the House majority, but by a smaller margin than most people thought. The final count is going to end up being 222 to 213 for the Republicans, although it'll begin in January as 222 to 212 because there was a congressman from Virginia, a Democrat, who passed away a couple of weeks ago that created a vacancy. So they'll open in January with one vacancy, and that'll be filled by special election in the weeks ahead. To give you a sense of how narrow that majority is, Republicans won 7 of the races that they captured in the House by less than 1% of the vote, including 2 races by about 500 votes each. So it just was a handful of votes, really, in that kind of created the Republican majority. When looking back on this midterm, I think one of the things that we'll all realize is that the oldest cliche in politics is that candidates matter. And I think in this election, we saw that, particularly on the Republican side, where I think Republicans are ruining the fact that maybe they lost some opportunities to win winnable seats in the Senate, winnable governor's races, when they nominated candidates that were maybe a little outside the mainstream, and those candidates couldn't kind of pivot back to the center for a general election and win independent voters in particular. So, we saw that play out in states like Pennsylvania and Arizona, and most recently in Georgia. And so that's one of the things I think Republicans in particular will be kind of looking back at and thinking about, how going forward can they make sure that they have nominees that can win the primaries and win their party's nomination, but then still have the capacity to move a little bit to the center to capture more independent voters. So we'll see how that plays out in the years ahead. So we've got a split Congress in 2023 starting in January, and that of course means gridlock. I think it's going to be really, really difficult to get a lot done over the next couple of years. And when you think about where are some areas that you could find compromise, it's a pretty short list. I think both sides are interested and interested in working together on some big tech regulation, whether that's some expanded privacy measures, also using antitrust laws to maybe crack down on some of the big tech companies for pushing out smaller competitors and that sort of thing. So that's a possible area of compromise. I'm going to come back to cryptocurrency regulation later in my comments, but that's clearly right now a front burner issue that is attracting a lot of attention, and I think has some real bipartisan support around creating a better regulatory framework for cryptocurrency. There's some energy issues around making it easier to get permitting done for energy projects and that sort of thing. But it's a pretty narrow list of things that the two sides are likely to be able to work on. And keep in mind that they still have to do the sort of basic business of Congress. They have to pass a budget. They have to fund the government. So there are a number of things that they're going to have to find places to compromise on, even though the divided Congress seems like not a lot of common ground. When you have a split Congress, like we're going to have over the next 2 years, that tends to be a time when the regulatory agencies in particular sort of step in and fill the void. And I think you'll see in the year ahead a very active regulatory agenda. I'm going to talk a little bit about some of the things that are on that agenda in a few minutes. But you're going to also see the use of executive orders. And executive orders coming out of the White House has been something that really over the last decade or so has really increased as the president tends to kind of see how far he can push the boundaries, whatever party he may be from, to try to put in policy policies that he favors. And that's mostly because it's so hard to get things through Congress. So I think we're going to see a lot of regulation and a lot of executive orders in the year ahead. A couple more thoughts about the historical context of this midterms. There's no question Democrats outperformed expectations and really outperformed historical trends. I've been saying that there's this odd dynamic in Washington right now. Republicans won control of the House of Representatives and feel badly about how they did in the election overall. Democrats, of course, lost the majority in the House and feel good about how they did in the election overall. And that's because of their outperformance of some of these historical trends. So you see here, the midterm election is notoriously terrible for the president's party. Over the last century, the president's party has lost an average of 30 seats in the House of Representatives. And actually, over the last 60 or 70 years, when the president's approval rating is below 50%, and President Biden's rating remains below 50%, the scale has been even worse of losses for the president's party. But here in this election, even though you had that historical baggage, Democrats only lost 9 seats in the House. That did flip the majority, of course, but not the kind of blowout that people expected. Similarly, in the Senate, this is only the 7th time in the last 25 midterms that Democrats have actually gained a seat in Congress when there was a Democrat in the White House. And the president's party has only picked up governor seats twice now since 1934 in a midterm election. This is the most recent time because Democrats did gain 2 governor's mansions, a net of 2 governor's mansions in this election. So a real significant outperformance for Democrats, even though they lost the House. And of course, you'll all be excited to think that the 2024 campaign is already underway. Of course, former President Trump has already announced that he's going to seek election again. But there are a whole number of Republican candidates who I think are potentially interested in challenging. Most eyes right now on Governor Ron DeSantis in Florida. Governor DeSantis was overwhelmingly reelected, and his outperformance in Florida was a real bright spot, I think, for Republicans in general. Not only did he win by a large margin, but he won in parts of the state where Democrats don't typically do that well. He also had great coattails. Because of his coattails, 20 of the 28 members of Congress, members of the House of Representatives, are going to be Republicans starting in January. So a big Republican delegation coming up from Florida to Washington. So I think everyone's kind of got, buzzing around whether Governor DeSantis might challenge President Trump. Polling shows a pretty favorable result for him right now. He's not, I don't think, going to make any decision for several months, probably well into 2023. And I think it's absolutely an open question as to whether he'll actually run. He has time. He's young. He could wait to the next election if he wanted to. So we'll see. On the Democratic side, President Biden has said all along that he is planning to run for re-election. He did say after the midterms that he's going to take some time with family over the holidays and make an official announcement sometime early in 2023. Of course, age is a huge factor with both President Biden and former President Trump, and it'll be interesting to see how that plays out. A lot of voters from both parties interested in maybe seeing a younger type of candidate come up. But we got a ways to go, but that'll certainly start to pick up as we head into 2023. One of the questions that I get asked, probably the question I get asked most, does the market care about elections? And so this, I think, is a really, really interesting chart. And before I talk about the red circle, just look in the middle of this chart, because this is a chart that looks at how the market has performed under different configurations of Congress. And you see here that the most common configuration we have had over the last 120 years is the one we have right now. Democrat in the White House, Democrats controlling the House and the Senate. But the second most common is the opposite, Republican in the White House, Republicans controlling the House and the Senate. And you see in the middle there that the difference in market performance in those two scenarios is about a 0.5 percentage point, which I think is a real reminder that the market doesn't really care about the outcome, care about the horse race. Interestingly, the one that we're heading into is the one in the red circle there. So Democrat in the White House and a split Congress. If you look at that column on annualized gain, you think, well, that's the best annualized gain. This is the best outcome for the market. Except you look at that column all the way to the right, and you see it's the least common over the last 120 years. In fact, it's only happened twice. A 4-year section of the Obama presidency is the only time in 120 years that we've had a Democrat in the White House and a split Congress. So even though it's a good result in those years, maybe not enough information there to rely on in any way. What I want you to take away from this chart is the market doesn't care about what the count is in the House or what the margin is in the Senate. The market cares about what Congress does. And I'll give you an example. A year or so ago, Congress, in a bipartisan fashion, passed a huge infrastructure bill, about $1 trillion in spending on roads and bridges and airports and rail and all sorts of infrastructure projects. But historically, infrastructure spending by the government, good for the industrial sector, good for the materials sector. It's just good for big companies that make machines that make roads. I mean, it's that kind of simple connection between a policy outcome and the market actually caring about it. Market doesn't care much about the sort of abstract, what might happen in a particular political configuration. So just an important reminder not to get too caught up in sort of who's ahead and who's behind in terms of Washington and how it'll affect the market. This is a good chart that hopefully gives us some hope for 2023. This just looks at how the market has performed in each of the 4 years of the presidential cycle. And out there on the right, you'll see that's the year that we're heading into. So the third year of the 4-year presidential cycle has historically been the best. It's returned a double-digit return, and it has returned positively nearly 80% of the time. So that's the year that we're heading into. This chart actually takes that even one step further. If you look at the S&P 500 and you start the count on election day, midterm election day, and you go a year, so 365 days from election day to the next year, the market has been in positive returns after every midterm election since 1950. And the annual return is more than 18%. So, as we like to say, past performance, no guarantee of future results, but certainly this is a result that I think we would all certainly embrace and support after 2022. So with that, I'll dive into some of the policy issues that are going on. And, when you have a narrowly divided Congress like we've had over not only the last couple of years, but really over the last decade or so, it's been really hard to get significant things done. And you see in the media, the Congress gets sort of labeled as a do-nothing Congress, except this Congress actually did a bunch of things that I'm not sure have been articulated even by the White House and by Democrats who have the majorities in a very effective manner. And it really started early this year when Russia invaded Ukraine, and Congress lined up in an overwhelming bipartisan manner to support Ukraine with military aid, humanitarian aid, economic aid. So far, we've now had 3 bipartisan bills totaling $66 billion in aid. I think there are some cracks in the support. I don't think it's anyone really thinking, we're not supporting, don't want to support Ukraine. But I do think that there's going to be, as we move forward, more strings sort of attached to that money, more tracking and transparency of where that money goes and that sort of thing. So it's not really about losing support for Ukraine. It's more about wanting to increase the transparency and the kind of accounting of where that money goes. But once those bills happened in the early part of the year, that sort of pushed Congress to start working together on some other things. And by summer, we saw the first bipartisan gun legislation in more than 2 decades. We saw a huge veterans healthcare bill, and we saw a piece of legislation that I just don't think gets the attention that it really warrants. That's this bipartisan $250+ billion bill known as the CHIPS and Science Act, really designed to compete with China. And it has 2 big parts. One is more than $50 billion in direct investment, direct subsidies and support for the US semiconductor industry. This is actually pretty unusual for Congress to put money directly into one industry. But when that bill was signed into law in August, a week later we saw Intel break ground on a semiconductor manufacturing plant in Ohio. We saw Micron break ground on a semiconductor manufacturing plant in Idaho. And just recently, we heard that TSMC, the large Taiwanese semiconductor manufacturer that is already building a plant in Phoenix area, is going to triple their investment in that, and they're going to benefit from this money too. So that's really a significant boost for semiconductor companies. The rest of that money is going to go towards, over the next few years, towards supporting and building and developing the next generation of talented scientists and researchers and technologists, particularly in cutting edge fields that China has been excelling at, whether it's artificial intelligence, quantum computing, rocketry, space exploration, all those sorts of things. This is about, supporting STEM education at the high school level, supporting research universities to partner with businesses on cutting edge projects and that sort of thing. So that's more than $200 billion in subsidies and grants that are going to go out over the next several years to help us compete with China. And then finally, the Inflation Reduction Act, very much not bipartisan. This is the legislation that passed in August that did not have a single Republican vote in either the House or the Senate. A major bill focused on climate change, prescription drugs and other healthcare items, deficit reduction. And when you talk about the Inflation Reduction Act, one of the key things to know is that this is the most ever spent to combat climate change. But what's interesting about it is that it just takes a really long time to get that money out there, which is why I think calling it with the Inflation Reduction Act was a classic Washington bit of nonsense, because it's not going to reduce inflation because it takes so long to get that money sort of out and going there. And I draw the comparison to the infrastructure bill that I mentioned earlier that was signed into law a year ago. A year plus later, a fraction of that money has even gotten out to projects yet. And that's because of the lag with permitting and competitive bidding and all that sort of thing. Most of that infrastructure money is 2, 3, 4 years out from entering the economy. Similar with the Inflation Reduction Act. The money to combat climate change is a myriad projects, everything from greening the manufacturing process to supporting the manufacturing of wind turbines and solar panels, to helping local communities buy electric school buses, to installing charging stations for electric vehicles along the nation's highways, and dozens of other projects. But a lot of that money is going to take a long time to get out there. I mentioned electric vehicles. One thing to know in the Inflation Reduction Act, there is a new tax credit kicking in at the beginning of the year for the purchase of an electric vehicle, 7,500 hours. However, a bunch of caveats. There is an income limit on who's eligible. There is a limit on the price of the car for what cars are eligible. But the most important thing is that the vehicle needs to be manufactured here in the US, which right off the gate takes Hyundais and Kias and BMWs off of the eligibility list. But also the battery needs to be sourced, and the material and minerals need to be sourced from the US or from a US trading partner. Today, the vast majority of electric vehicle batteries sourced from China, so they won't be eligible either. So the government's about to put out a list of what electric vehicles are eligible for the tax credit. Won't take you long to read, because right now there are not a very long list of cars that are going to meet that. The other thing that's grabbed a lot of attention in the Inflation Reduction Act is the $80 billion in increased funding for the IRS. Depending on where you live during the political season over the last couple of months, you may have seen these ads about how the IRS is going to hire 87,000 armed auditors to storm the streets of suburbia looking for tax cheats. Not quite sure that's what's going to happen. First thing they're going to do is hire a bunch of people to answer the phone, because no one answers the phone at the IRS. Their customer service is terrible. They're going to hire a bunch of people to go through unprocessed returns from last year that have piled up. And ultimately, yes, they are going to hire more auditors. They are going to target audits on the wealthiest filers and try to close what's known as the tax gap, the difference between what is owed in taxes and what is actually paid. But at the end of the day, I don't know that this huge infusion of IRS money necessarily is going to change anyone's life in any significant way. The other thing, of course, is that it's a political football. Republicans have already said when they take over the House in January, they're going to put forward a bill to repeal this money. Of course, with Democrats in charge of the Senate, I don't think that's going to happen, but this is going to continue to be something that is fought about for a while going forward. And then finally, the other thing to know about the Inflation Reduction Act, no individual tax increases in the new law. That's a big change from where the legislation started more than a year ago. At that time, there was a real focus on increasing taxes on wealthy filers, everything from taking that top individual income tax rate up to 39.6% again, creating a new cap gains dividends rate for wealthy filers, reducing the amount you could exclude from the estate tax. There were even talks of straight wealth taxes. For a very brief moment last fall, there was talk about trying to tax unrealized gains. Happily, that immediately fell by the wayside. Ultimately, all these ideas disappeared. And the bill that finally passed Congress, only corporate tax changes. So a new 15% on 15% minimum tax on corporations, big companies, $1 billion or more in profits for 3 consecutive years and paying an aggregate rate of less than 15%. They'll just have to bump up to 15%. It's going to affect probably 100 to 150 of the S&P 500 companies, but we'll see, to what degree over the next year or two. And then finally, there's also a new 1% tax on stock buybacks that goes into effect in January that is designed to try to discourage buybacks. We'll have to see. And other economic things that we're focusing on, obviously all eyes on the Fed today and tomorrow with the announcement tomorrow afternoon of the last monetary policy move for 2022. Obviously, we've had 4 consecutive 75 basis point rate hikes. All senses right now are that the Fed will slow the rate of increase probably by passing or announcing a 50 basis point increase tomorrow. I certainly think today's improving CPI numbers will probably support that kind of step. Our view is that we're probably looking at another 25 basis point hike early in 2023, and then depending on all the numbers, sort of a flattening there. I expect that the Fed will sort of hold at that 5 to 5.25% for an extended period, depending, of course, on that inflation number continuing to come down. Other things we're watching: the student loan debt relief, the president's plan to forgive up to $10,000 in student debt. That is and has been challenged in the courts. The administration has challenged it or is appealing it to the Supreme Court. The Supreme Court has said they will take that case and that they'll try to expedite it. I think we'll see arguments in that case probably in the February-March timeframe. And until then, the debt relief plan is in limbo pending the outcome there. And then I would say the biggest issue I'm worried about in 2023 for the markets coming out of Washington is another debt ceiling fight. So the debt ceiling is the cap that Congress puts on the total amount of debt that the United States can accumulate, currently at $31.4 trillion. We're going to hit that level sometime in the next few weeks. And then there'll be a period where Treasury Department can sort of move paper around what it calls extraordinary measures to make sure the United States does not default on its debts. But that's a finite process. And probably by mid-2023, Congress is going to have to find a way to raise the debt ceiling. Now, why is this going to be tricky? It's because of that split Congress. The last time we had this situation was the worst debt ceiling fight we've ever had. That was the summer of 2011. President Obama was in the White House. We had a split Congress in exactly the same way we're going to have a split Congress in 2023. And they could not agree on the debt ceiling. They had a standoff that lasted months. We got the closest this country has ever come to defaulting. Markets went crazy, volatility spiked, Standard & Poor's downgraded the US credit rating. Really, it was the market, sort of reaction around the uncertainty about what would happen if the US defaulted that spurred members of the Republican and Democrats on Capitol Hill to come together and make sort of a last minute deal to avoid that. I think we're looking at a very similar situation in 2023, probably late second, early third quarter is when this is going to come to a head. And it's something investors should have their eyes on, because it's something I'm really worried about, sparking volatility, particularly at a time when hopefully that inflation number is still coming down, and the market is we hope and responding positively to that. So that's something that all investors should have their eyes on. Of course, Congress is still in town today and trying to get across the finish line for the year. The big deadline is looming on Friday. That's when the temporary agreement to keep the government open and operating expires. That dates back to the end of the fiscal year on late September, when Congress is supposed to pass the 12 appropriations bills that fund every government agency, every federal program, by the beginning of the government's fiscal year on October 1st. Now, they almost never get it done by that time. And this year, they got exactly 0 of those 12 appropriations bills done by that time. So they passed a temporary agreement, just keep the government funded at current levels, all programs funded at current levels through December 16th, which is this Friday. They're trying to kind of hammer out a longer term agreement that'll take us through the rest of this fiscal year. I don't think that's going to happen in time. So there's already queuing up a plan to extend government funding for 1 week to December 23rd to allow for more negotiations. Basically, kind of 2 outcomes here. I don't think a government shutdown is one of those. The 2 outcomes are that Republicans and Democrats get together on a giant spending bill that kind of mushes everything together into one big bill, funds the government through the end of the fiscal year and at the end of September, or they just do another temporary extension to say February and just tell the new Congress coming in January, it's your problem, you guys figure it out. So we're going to be watching next week to see what happens. As happens with these end of the year, end of Congress bills, lots of other things that people would like to attach to that, whether it's defense spending, Ukraine aid, hurricane relief, any sort of pet project that any member of Congress wants to get across the finish line before the end of the year. They're looking at this government funding bill and saying, maybe I can attach to that. The thing that we're in that context, the thing that we're watching the most is a retirement savings bill known as Secure Act 2.0. This is legislation that has strong bipartisan support. And among other things, it would increase the age at which you have to begin taking required minimum distributions from your retirement account from 72, where it is now, to 75. The trick is, we don't know exactly when it'll take effect, because the House and Senate have different approaches. The House would do that in a step-stair fashion, 73 next year, 74 in a few years, 75 in a decade. Senate would just go directly to 75 and not for many years down the road. So they're trying to find kind of a compromise in the middle. I think the bottom line is that that required minimum distribution age is not likely to go up at all next year, but maybe in subsequent years it'll go up and ultimately get to 75 somewhere down the road. So stay tuned on that. We should know details in the next several days. The bill would also increase catch-up contributions, allow people who are approaching retirement age to save more for their retirement. And it would do a whole bunch of things to help 401k plans, to help businesses start a plan, to strengthen their plan, to help part-time workers and other employees get in the plan faster. Basically, just trying to make it easier for people to save as much as possible for retirement. So the House and Senate are sort of working out the differences between their bills, and I expect they'll have a compromise package, and they'll hope to attach it to that government funding bill at the end of what looks like the end of next week. I still think there's a really good chance that this happens, but we're waiting to sort of see how the details shake out. And then I also wanted to mention that one of the odd impacts of high inflation this year is that it's resulted in these pretty significant adjustments to various tax provisions for 2023, because each year the IRS adjusts things based on inflation to reflect inflation, essentially, and makes a bunch of changes to the tax levels. So, for example, the estate tax exclusion, currently at $12.06 million per person, will go next year to $12.92 million per person in 2023. The annual gift tax exclusion, which is when you give a gift to a child or a grandchild, for example, you can give up to $16,000 right now in a calendar year tax-free. That'll bump up to $17,000 in 2023. All of the income tax brackets will go up by about 7%. So you see here, I put the top tax bracket in here, but all of the brackets will just shift up by about 7% increase in income before you sort of flip into the next income tax bracket. 401k and IRA contribution limits will both go up. 401k contribution limit goes up to 22.5. IRA contribution limit goes from 6 to 6.5 for next year. And then one other thing we're watching is there's been a lot of confusion around inherited IRAs, particularly what are known as non-spousal inherited IRAs. So if you're a child or a grandchild and you inherited an IRA, under a change in the law a few years ago, that account needs to be essentially liquidated. You need to distribute the assets in that account within 10 years, by the end of the 10th year following the death of the owner. When that change came out, people looked at that and said, well, it looks like you can do that in whatever way you want. So you could take it a little bit each year. You could take it in a couple of lumps. You could wait till 9 years and 364 days and take it all on the last day or something like that. Earlier this year, the IRS came out and said, nope, you're supposed to be taking required minimum distributions each year. So basically, they're going to tell you how much you have to take out of that account each year to work it down to zero at the end of the 10 years. However, that was kind of a change, and people complained because they said, well, wait a second, there's a penalty for not taking these required minimum distributions, but I didn't know I was supposed to be taking them, so how can you penalize me? As happens just in the last few weeks, the IRS has come out and said, you're right, that's not fair. We're not going to penalize anyone who didn't take required minimum distributions from an inherited IRA in 2021 or 2022, but starting in 2023, you got to be on the ball to do that. So that's something to be aware of if you have inherited an IRA in the last couple of years. Finally, I wanted to end with just a few regulatory issues. The SEC, which regulates the markets and investor protection, huge agenda, lots of issues that they're working on. They are supposed to put out twice a year their sort of regulatory agenda. The one that they did in the summer had 53 different topics that they're working on. Bloomberg called it the crackdown on everything. But I wanted to highlight just a couple of things. One of those things is actually happening tomorrow when the SEC is meeting and expected to propose a series of rules to overhaul kind of how our markets work, particularly on the equity trading side. And what they're really looking at here is kind of what happens when you push trade on your computer, disappears, and then it comes back and says, here's what you got. What happened inside that market pipeline, inside the plumbing? Where did it go? Why did it go to a particular trading venue? Did it go to the New York Stock Exchange? Did it go to somewhere else? And did you get the best outcome you're supposed to get? You, by law, as an investor, are supposed to get what's known as best execution. That's the best outcome for your trade at that particular moment. It's really hard, I think, for an investor to know whether they got that best execution because you just don't get a lot of transparency and vision into that. So the SEC is going to propose a series of rules to try to put some more clarity around that. Also to try to sort of control how trades are routed and that sort of thing. We're all watching this in the industry with a lot of interest. So the details will come out tomorrow, but potentially big impacts for how trading works over the next in the future. The way SEC rules work, you put out a proposal, there's a public comment period, there's a lot of analysis of it. So we're talking about something that's a year or two down the road once, if and when it becomes final. The other area that's getting a lot of attention is ESG investing. Environmental, social, and governance-focused investing. This has become a really hot topic in Washington. The SEC has already kind of dived into this by proposing a very controversial rule for public companies to disclose more about their impact on climate change and their risks that they face from climate change in the future. And in particular, companies are not happy about this because not only would they have to disclose more to investors about their greenhouse gas emissions, but they'd have to go all the way down their pipeline, essentially down their supply chain, and make sort of estimates about the environmental impact of that entire manufacturing process and delivery process and that sort of thing. And they're not happy about having to do that. Not even sure, a lot of companies, how they would calculate some of those things and that sort of thing. So this is something that has attracted a lot of attention. The SEC is trying to push us across the finish line in the first quarter of 2023. I expect there'll be a lawsuit if and when it happens, a court challenge to it. This is definitely something that arouses a lot of passion in Washington. And generally speaking, ESG issues have just become a real sort of political football, whether it's states, talking about how state pension funds are invested and what kinds of companies, what kinds of activities companies should be undertaking and that sort of thing, or other issues around, just what the government's role is in either, supporting or not supporting this type of investing. It's become a really hot topic. One of the other rules that we're watching is the SEC has proposed updating what is known as the names rule, which literally means the names of mutual funds and exchange traded funds. And it's ostensibly going after words like, the so-and-so green fund or the so-and-so sustainable fund. And what do those words mean? And what does it mean for how the portfolio is invested in that particular fund that is under the description of these certain words? So they're trying to put some standardization around that. Again, controversial in that there's been a lot of pushback about whether the SEC should even be involved in this sort of thing. And then finally, I mentioned earlier that I'd say a few words about cryptocurrency. Obviously, the collapse of FTX, the second largest crypto exchange last month, attracted a ton of attention. It is a hot topic du jour, literally, here in Washington, because the House Financial Services Committee hosted a hearing earlier today about the FTX collapse. The Senate Banking Committee will do so tomorrow. Lots of attention focused on the young founder and former CEO of FTX, who was arrested overnight in the Bahamas for fraud in the collapse of that exchange. So that has really focused, I think, a lot of energy in Washington on, wow, we better create a better regulatory sort of framework for crypto, or we're just going to have people keep getting hurt by these kinds of schemes. So there's real bipartisan interest in trying to draft something, to put in a law in place that better protects investors in cryptocurrency. Lots of different agencies that are looking at it, whether cryptocurrency should be an option for people in retirement plans to invest in, or should the Fed get involved in creating its own digital currency so that it can compete with other countries that are doing so and that kind of thing. So a lot of this, I think, is going to come to a head next year because of what's going on in the space. And I definitely think this is going to be an issue to watch in 2023. So with that, maybe I'll wrap up by just saying, if you want to follow my commentary, I'm on Twitter, at least until Twitter just completely implodes and I'll find somewhere else to go. But at Mike Townsend CS right now. And then, as was mentioned, I have a podcast called Washington Wise. Just did my wrap-up episode for 2022 late last week. On that episode, you can hear from some of my company's other experts, including Liz Ann Saunders, our chief investment strategist, and others about sort of what the prospects are for 2023 investors. So give a listen to that. You can find it on Apple or Spotify or wherever you listen to podcasts, or you can just go to schwab.com/WashingtonWise. Don't have to log in, don't have to give us any information. You can just play it right there on your screen. So with that, I'll show my microscopic little disclosures that all presentations have to have in this business. And then I'm happy to stop sharing my screen and just see if there are a couple of questions out there that I can answer.
Thanks, Michael. If anybody has any questions, just hit the Q&A button at the bottom. We do have a few. Along the lines of cryptocurrency, top of mind, if you were watching TV today, who's going to give back the campaign contributions and who's going to be first?
So this is an interesting one because Sam Bankman-Fried, who's the now ousted founder of FTX, gave millions and millions, particularly to Democrat candidates, but actually his number two gave lots and lots to Republican candidates. And so now there's a big question about, whether they're gonna claw back those donations as part of the bankruptcy process. What's been happening a lot is that members of Congress are donating, making a donation to charity in the name of, or in the amount that they received from Sam Bankman-Fried or others. Which is very typical. Whenever some donor gets in hot water, you turn around and make a contribution from the campaign to some kind of charity. So I think you're going to see a lot of that over the next few weeks.
It's amazing. Whereas if an individual investor was unfortunately invested in a fraud and took their money out before everyone else, they claw back. They can't go back to the SEC or whatever and say, "Oh, I'm going to give it to charity." But as a congressperson, you can go ahead and give it back to charity, but not give the cash back as a clawback.
Yeah, welcome to Washington.
And you write the laws, it's all well and good. Speaking of laws, stock trading policy, what's the potential of that ever getting passed, where it's just absurd that Congress members can go ahead and trade at will, when in fact they're part of voting for particular policies here and there?
This is interesting. If you had asked me this question 9 months ago, I would have said, I'm sure it's going to pass here by this year. And somehow just doesn't happen. And you wonder why that is, because putting restrictions on themselves is, of course, really difficult to do. But, in the wake of some scandals, particularly, at the Fed, where you've had a couple of Fed bank presidents who were trading inappropriately and stuff, they're trying to put a framework around, who's trading and how they disclose that information. So I got to tell you, I would have thought that it would have happened this year. Obviously, it doesn't look like it's going to. And at the end of these days, it's cynical to say, but these guys protect themselves at all costs. So
that's sad, very sad. Let's see. How about Social Security and Medicare reform? Anything?
Yeah, Social Security is a tough one because there's all sorts of calculations that are done that the Social Security Trust Fund puts out a report each year that sort of says what we've all been hearing for years, which is, they're going to run out of money and not be able to pay full benefits somewhere down the road. Right now, the year is around 2034, I think, which isn't that far away. But, from a political perspective, that's like multiple lifetimes away because it's multiple elections away. And so there's not a ton of urgency around it quite yet. The other thing, though, of course, is that, all the choices of what to do about it are bad. Right? I mean, you can, from a political standpoint, you can raise the retirement age, you can increase the amount of income that is taxed, you can raise the tax rate. These are not things that these guys want to vote for. And so that's a big issue. The Medicare is even more of an urgent situation. And there is, I think, more attention paid to Medicare. And actually, with Republicans in charge in the House, I expect you'll see some efforts to try to shore up Medicare, in the year ahead. Whether they'll find compromise with Democrats, I think is going to be tough, of course. But there is, I think, more urgency, more sense of urgency around the Medicare question.
How about as far as COLA increases? $31.4 trillion debt, interest rates going higher. How the heck can we afford this going forward?
It's a great question. I've been getting asked this a lot over the last few months because, one of the things that you heard really over the last, 8 to 10 years is, well, the cost of servicing the debt is so low right now because interest rates are so low. This isn't really a big deal. And this is all going to come home to roost now with much higher interest rates. So there is some sensitivity to that. Again, though, this is a question. When I talk about the debt ceiling, you're not talking about reducing the debt. You're literally talking about raising the cap on the amount of debt that you can accumulate. And that's what the big debate is about. Republicans are going to really push for spending cuts to try to start to address that. But this is a really, really tough one. And I think everyone wonders here in Washington on Capitol Hill and elsewhere, sort of when is the time when this really becomes an unbearable problem? Are we getting to that point with increased interest rates and where you really start to take up a lot of GDP, is starting to go towards servicing the debt. So we'll see. I don't see a magic solution out there, but I know there's increased worries about it.
I'm sorry, was this the Deficit Reduction Act that we were talking about? Okay.
Yeah.
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 So does that mean MMT is dead?
Does that mean what?
MMT, modern?
Yeah, I mean,
monetary theory?
modern monetary theory has kind of bounced around here over the last, 5 to 8 years, but hasn't sort of grabbed a hold enough to become a policy core or anything like that. And I don't think I see that in a split Congress either.
And I'm just going to end with, I had no idea about and we have a lot of clients, even friends, that are looking forward to their EV tax credits, but that battery, the minerals in a battery, that is the first I've heard about that.
Yeah. Yeah, that's why I say that list of what's eligible is going to be pretty short. At least initially.
Not many minerals
Working
are
on it.
coming from this country, right?
Yeah, Hyundai just broke ground on a plant in Georgia, but it's, they're hoping to open in 2025 and, that kind of thing. So it's going to be a little while.
Wow. Okay. We're about done here. Michael, I can't thank you enough for taking the time out to speak with us. And let's keep our fingers crossed, a few things getting done in the 118th Congress.
We'll do our best. Happy holidays, everybody.
Okay, take care. Same to you. Bye-bye. Thank you, everyone.